In recent weeks, more and more reports in leading business outlets such as Financial Times, Bloomberg, and Caixin Global indicate that McDonald's may soon face serious challenges in one of its most important and fastest-growing markets, China. According to sources close to the Chinese holding DCOS, the company has developed an innovative artificial intelligence-based food preparation system that has managed to almost fully reproduce the flavor profile of McDonald's menu. Preliminary tests suggest a taste match of over 90%, which by fast food industry standards is considered an almost perfect copy. Insiders emphasize that this is not simply about copying individual products, but about a comprehensive system capable of recreating the distinctive taste of burgers, fries, and drinks that for decades defined the face of the American giant. McDonald's has traditionally been seen as a symbol of globalization, a benchmark of American business success, and one of the main exporters of the American dream in everyday culture. A network of more than 40,000 restaurants worldwide has become part of the collective memory of several generations. But it is China, McDonald's second-largest market after the United States, that may become the arena for serious change. DCOS has not yet officially announced the launch of the new menu, but according to industry sources, the presentation is expected in the coming months, with plans to offer products at lower prices than McDonald's. To avoid lawsuits, recipes will be slightly altered, minor differences in sauce flavors or bun textures. But experts are confident that most consumers will hardly notice the difference. Analysts at Nikkei Asia note that price is a decisive factor for Chinese consumers. In recent years, McDonald's has repeatedly raised prices in China amid inflation and rising operating costs. Now, DCOS can strike precisely at this vulnerable point by offering a comparable product at a lower price and made in China, boosting the appeal of national brand support. In the context of growing economic rivalry with the United States, this move is perceived not only as a business strategy, but also as part of economic competition. Still, it is too early to speak of the collapse of McDonald's. Experts at the Wall Street Journal stress that McDonald's brand carries immense cultural capital. For millions of people worldwide, it symbolizes stability, a familiar taste, and trust in quality. McDonald's has long ceased to be just a chain of restaurants. It is part of global identity, and many consumers are unlikely to abandon it even for a cheaper alternative. Moreover, McDonald's is actively investing in digital technologies, loyalty programs, and delivery services, giving it a long-term competitive edge. Nevertheless, within the industry, there is already discussion that the emergence of an almost identical Chinese alternative could mark a turning point. According to Euromonitor International, China's fast food market could exceed $200 billion by 2030. If DCOS manages to capture even 10 to 15% of the segment currently dominated by McDonald's, the American company would suffer significant losses. Some analysts even predict that the situation could escalate into a new phase of the US-China trade war, where not only chips and oil but also burgers become symbols of global rivalry. In Washington, discussions are already underway, with the White House closely following the story. According to Politico sources, the Trump administration is considering additional support measures for American corporations operating in China, including McDonald's, to prevent a symbolic defeat in a sphere so closely tied to everyday consumers. On the other hand, Beijing has so far refrained from official comments, but Chinese state media are actively promoting the narrative of technological superiority of local companies and China's ability to independently set standards even in sectors such as fast food. Experts at Harvard Business Review note that the McDonald's case could become a survival test for global brands in the new world, where Chinese companies are increasingly relying on artificial intelligence and local innovations to compete with Western giants. If replicating the taste of McDonald's proves successful and consumers accept DCOS products as an equivalent substitute, it could pave the way for similar moves in other industries. Today it is burgers and fries. Tomorrow it could be coffee, soft drinks, or even luxury cosmetics. This means that at stake is not only market share in one country, but something larger: trust in American brands as benchmarks of quality. If McDonald's loses China, it would be a troubling signal for the world. The era of unquestioned dominance of American corporations in mass culture may be nearing its end. And although millions of loyal fans are unlikely to trade a Big Mac for a Chinese equivalent, the very fact that such competition exists already points to profound shifts in the global balance of power. This story could become one of the new episodes of the US-China trade duel, where the battlefield is expanding from oil and technology to the simplest and most familiar things, the food we eat every day. What makes the case especially interesting is how Dicos managed to achieve such a high level of taste replication. According to experts cited by Reuters and the South China Morning Post, the Chinese chain has in recent years actively invested in food technology research. In laboratories in Chengdu and Shenzhen, engineers worked with university specialists to develop machine learning algorithms that analyze the chemical composition of McDonald's products, reproducing flavor profiles literally at the molecular level. Technologies usually applied in pharmaceuticals and bioengineering were redirected toward the fast food market. Insiders say it is not only about traditional ingredients, but also about automated cooking systems, where robots and artificial intelligence completely remove the human factor, ensuring stability and consistency of taste. This aspect could become another major challenge for McDonald's, since automation allows Dicos to cut costs significantly. While the American corporation remains heavily dependent on human labor and must account for rising wages and social standards in China, the local company enjoys a clear advantage. Robots do not need vacations, sick leave, or pay raises. As a result, Dicos can not only offer lower prices, but also maintain higher margins. Analysts at Morgan Stanley have already warned investors in private notes that the Chinese fast food market may be entering a phase of sharp transformation, where technology, not brand, will be the key factor for success. Meanwhile, uncertainty is growing inside McDonald's. According to Business Insider, the company's leadership in Chicago and Hong Kong has been holding emergency meetings to discuss possible responses. Options include accelerating the rollout of new products, localizing menus to Chinese tastes, and even partially moving research centers to Asia to respond more quickly to challenges. But here lies another risk. McDonald's has traditionally built its success on menu uniformity, where a Big Mac in New York was meant to be almost identical to a Big Mac in Beijing. If the company starts drastically altering recipes in China, it risks losing its unique advantage of global standardization. Some experts believe the emergence of a Chinese twin of McDonald's may also carry a political dimension. According to Financial Times sources close to Chinese regulators, Beijing views the fast food market as part of a broader strategy of import substitution and strengthening domestic brands. In the context of the trade war with the United States, a symbolic victory of a Chinese company over an iconic American corporation would send a powerful signal, both to domestic audiences and to the world. If China is able to replicate and even improve what was once considered a hallmark of the American way of life, it means the balance of cultural and economic power is truly shifting.